Good morning. I hope you're all well. I was vaccinated yesterday. I'm very excited to say. They did warn of generalized stiffness for a day or two. I hope they weren't talking about my presentation skills. Anyway, moving swiftly along, let's look at July. So much for summer holidays and quiet summer holidays in the Northern Hemisphere. July was an amazing month, just unbelievable what happened. We had level 4 lockdown, we had dreadful looting and violence in South Africa, wide sweeping Chinese regulations causing trillions of dollars of damage. There's a lot to cover today. Looking at the chart here, you can see a sea of red in the east for the month of July. Chinese equities down the most, but emerging markets down as well, including China and excluding China. Japan also red for the month of July. And then the only green seen in commodities and developed market equities, although quite small. The largest gains for the month relative were seen in global bonds as the safe havens were the place to be. Risk off month definitely in July. A lot of red and a lot of things to be worried about. So let's see what those issues are and how worried we should be. We have our old friend, Dr. Anthony Fauci here, talking about the Delta variant, saying the greatest threat to eliminating the virus. And certainly the Delta variant has been something that has caught everyone by surprise. I don't believe that it is the greatest threat to the economy though. For the economy, I'm worried about another D, disinflation. But certainly from a health perspective, the Delta variant is something to be worried about, or at least confused about. And that seems to be the general case. And the UK is a fantastic model for what's happened. They were exposed to 100% to the Delta variant, their new cases. And the vaccine seems to work well, and 95% less mortality than the previous waves, even with the Delta variant. So the good news is that the vaccines work out. The bad news is that it's estimated that it's 3 times more transmissible than the previous variants of the COVID virus. But what is even more confusing is what happened on the 19th of July. So on the 19th of July, the UK opened up its economy. Before that, very stringent lockdowns, restaurants, pubs, no social mingling, very strict lockdown rules. The economy opened up on the 19th of July, and for the last 2 weeks, the mobility increased significantly. People were able to go to restaurants and pubs. Masks weren't required. It was almost life as it was before. And what happened over those 2 weeks is what is surprising. The number of new daily cases halved from 54,000 to 23,000. So you went from very strict lockdown with very high caseloads, and suddenly this disease, which is 3 times more transmissible than the previous ones, the daily cases halved as the economy opened up. And what this speaks to is that we just really don't understand how this virus works. We may get a handle on it, and then there's a new variant. We do know that vaccine is helping, but we don't quite understand how it is spread. And I think what's important there is that governments have realized that. And until we better understand it, there's no point in locking down the economy completely like we had in the first and second waves. And we saw that within South Africa, fortunately. We had lockdown at just level 4, but the level of closures or the reduced mobility was far less than the previous 2 waves. Yes, we can debate whether alcohol should be banned, or we can debate whether restaurants should be closed, looking just at what happened in the last 2 weeks in the UK, but we don't know. But I definitely think that the impact on the economy going forward from this wave, or a 4th wave when it arrives, is going to be less, partly because of the vaccine, partly because of herd immunity, and partly because we're not sure of the impact that we're having with the lockdowns and whether it's actually adding any value. But we do know that it is harming the economy and harming jobs and harming people. So I think what's more important to look at is from a market's perspective anyways, the economy. And the chart on the right shows the US bonds versus the economic price index. And what you can see there quite clearly is that the plunge that we saw in global bond yields, and then obviously a jump in bond prices over the month of July, was very much driven by growth concerns, and not concerns, but hard data that's come out, so slowing growth. And there may be a concern that the Fed is going to hike rates too soon. And certainly growth has been slowing. China growth peaked last year. They were the first into the pandemic. They were the first out, and so their growth was the first to slow. The US slowed earlier this year, probably February, March. Europe is likely peaking right now. But the growth is slowing off a very high base, and growth is still strong. And we're just transitioning to a more sustainable economic upcycle. We're not anywhere near another recession. This economy is still, the cycle, we're still in the early stages of the cycle. And yes, the Delta variant will have an impact on that opening up of the economy. It will slow things down marginally, but with deaths and hospitalization rates way below previous cycles, and with acceleration of the vaccine rollout and very high levels of vaccine rollout in developed markets, excluding Japan, we certainly think growth will continue to recover. So the base case is that the growth will continue to recover over the next 6 to 12 months. Markets will continue to be buoyant over the next 6 to 12 months. And as a result, we're underweight global bonds, where we don't have any global bonds, and we remain overweight our value ETF, which we think will do well as global yields recover over the next 6 to 12 months. Certainly, I strongly believe that the growth concerns are overstated, that the Delta variant, as it spreads to the US, is not going to have the impact that it's expected to have. Longer term, we remain convinced about our low growth, high volatility environment. And central banks over the last 10 years, basically since the great financial crisis in 2008, have increased their balance sheets 8 times. Quantitative easing, central banks have bought government bonds and some credit bonds, and have increased their balance sheet 8 times. And they doubled over the last year since the COVID pandemic recession. So this naturally raises many red flags. People are worried about this causing inflation, and it has caused asset inflation. And certainly there's a lot of distortions in asset prices, and that's why we don't hold gold and we don't hold double bonds, but it hasn't impacted inflation. Euro area has been trying to get it to close to its 2% inflation target over the last decade, unsuccessfully. Japan has been trying to get inflation in its economy for the last 2 decades with QE and fiscal support, and it's also been unsuccessful. There's just too much debt and aging demographics to allow growth to recover like we did post-World War II. And a new headwind, which is something that a report has come out recently, talks about productivity growth. So one of the reasons we were able to grow out of the debt post-World War II, and particularly in the 70s and 80s, was the huge increase in productivity, partly driven by increase in technology. Computers was a big improvement to productivity. Being able to better manage stock control and communicate, reduce your inventory cycle, all very, very, very positive. However, there's a report out from BCA which says that over the last decade, where the technology innovations have been focused on social media, if you think about the FANG stocks and the huge movement there, everybody's now on their cell phones. They believe that social media has had a negative impact on productivity. So effectively, technology has had a negative impact on productivity over the last decade, not a positive one like it had in the 70s and 80s and 90s. And this is partly due to policy mistakes as governments react to social media, and social media, which is reflecting people who are fed fake news or led by fear campaigns. And the results, there tend to be overreactions or underreactions when compared to what would have otherwise happened. We look within South Africa, it's just completely anecdotal, but the looting and violence that we had, which was horrific, apparently was driven by 12 Twitter accounts. And if you think back to the Trump years, those late night toilet tweets that he would send out, and they certainly didn't help price stability or economic stability in any way. So that's just an interesting new headwind to growth. Not only do you have to worry about massive amount of debt and aging demographics, but the impact that social media is having not on people's emotional well-being, but on the economy as well. the bottom line is that we're unlikely to grow out of the current mess that we're in. Inflation is unlikely to take hold, and the most likely path over the next decade is that more QE will be needed. The chart on the right, the very, very right, is Japan. The squiggly line talks to the central bank balance sheet, and the smooth line is their GDP. And you can see that Japan has now got, its balance sheet is now bigger than its economy. So you've got roughly 6 trillion on bonds on their balance sheet compared to about 5 trillion with their GDP. The US and the Eurozone are well below. The balance sheets are nearly half what their GDP is. So over the next decade, we could easily see the US and Eurozone continue their bond purchasing, continuing QE, and that those central bank balance sheets easily rise to the size of the GDP like Japan has done. So there's no headwinds to kicking the can down the road. And when it comes to politicians' decisions about facing disasters, certainly they prefer the kicking the can down the road option. That's been plain to see over the last 30 years in Japan and the last 10 years in other developed markets, and I think it'll be the preferred option going forward. But looking more closely at inflation, everyone is talking about it. We've got Biden, he's talking about inflation. He says it's highly unlikely that it's going to be long-term inflation that's going to get out of hand. So everyone's jumping on the transitory inflation bandwagon. And I do agree that inflation is transitory. It is likely that it's going to stick around a bit longer than it's expected. So I think people will be surprised by how sticky it is, but it's definitely sticky in the short term. And it's not going to lead to structurally long-term inflation, just for the reasons I've mentioned before, high debt, low productivity, aging demographics. And in fact, inflation expectations have already fallen below the Fed's target zone. The chart on the right here shows where the Fed is worried about inflation expectations, and those have already fallen quite substantially below their concern levels. And this is understandable. The faster wage growth has been confined to a few low wage sectors. And what is very interesting is US manufacturing is far less automated than its peers in Asia and Europe. So low wage workers are at risk of being replaced if things don't change. And that's certainly one of the avenues that can be used to avoid inflation going forward. And it is certainly something that may need to happen with the US infrastructure package, which has been approved. And definitely, if you look at where inflation is occurring in the world, not just the US, but across the world, it's supply bottlenecks. It's related to supply closures because of the COVID lockdowns, and that will pass as the vaccine is rolled out, or just as economies learn how to deal with the pandemic. And we didn't have any industrial closures this third wave in South Africa. The mines weren't closed. It was business as usual. And I think the world's going to migrate more and more to that, not only where there are vaccines, but even where there aren't vaccines. So those bottlenecks should subside. Sticking with the US equities are looking overvalued. This is the main concern. Biden signed a sweeping executive order to promote competition across a variety of areas: drug prices, airline luggage fees, shipping, non-compete clauses, and in particular focus on tech companies' use of consumer data. And this definitely is a global phenomenon, something we've seen in China, and I'll talk about that later. But data is seen as a national asset, and certainly as a security asset. And there's a lot of focus not only on whether that's being used from an anti-monopolistic practice, but who has exposure to that. In South Africa, we had the POPIA Act, which has just come out, which is a bit terrifying to look at, but is something that we have adopted and should protect consumers going forward. Regardless, additional regulations and additional taxes in the short term do weigh on earnings. And we do think that there's going to be pressure on the US, particularly looking at valuations. US equities reached new highs in July and are looking overvalued relative to their history. In fact, the BCA price series suggests that US equity returns over the next decade based on current valuations are negative. So that's not something that you want to be too excited about. That's a lot of volatility for a negative return. I'd much rather keep your cash in your money in cash or elsewhere in other markets. And that's certainly what we are doing. And we are underweight the US in our portfolios. The chart on the right shows the US price to sales, revenue to sales. And you can see that not only is the US more expensive than the rest of the world, so that's the rest of the world is including developed markets, mostly developed markets, but it's not only is it the most expensive compared to the rest of the world over this period, but it's nearly double. In fact, it's just over double the price to sales value of the rest of the world, which implies growth that's going to be double the rest of the world. And it's hard to imagine that the US can grow at twice the speed of Europe and Japan and emerging markets. Certainly, they've got some great moats and some great businesses, but to double forever, that's a hard ask. Yes, the US has got some short-term or even medium-term support from infrastructure. The US bipartisan infrastructure bill was approved. That's an additional $550 billion over 5 years. So it's relatively small on a year-by-year basis, but it does help. And unfortunately, it's going to be outweighed by the taxes that need to happen, and the regulation is going to happen as well over that same time period. So we're very comfortable to remain underweight the US and use it to fund our overweight positions in other regions and other themes. Having a look at Europe, it's been a while since we've seen Christine Lagarde, and I'm a big fan of hers, and it's very nice to have her back in the press. Here she's talking about inflation, saying there might be some moderate temporary deviation in either direction of that 2%, and that is okay. Basically, what's happened is the ECB have realized that they haven't been able to meet their 2% target inflation. The chart on the right here shows inflation going back to 2003, and the top line, which hasn't been reached, is 2%. So in acknowledgement that inflation is just very, very difficult to achieve, they've adopted a similar process to the US. The US call it average inflation. ECB have called it symmetric inflation, but basically they're allowing inflation to creep up more than they have in the past, or when it gets to their target, they'll allow it to linger there more before they raise rates. Unfortunately, as you can see over the last 15 years, they've never been able to get it to that 2%. So allowing it to go past that point doesn't really help much if you can't even get it to that point. But maybe expectations will rise slightly with this more symmetric target, and they can improve inflation slightly. Certainly, things are looking very supportive from a fiscal perspective and a monetary perspective. The central bank will continue to support the recovery process even after its PEPP program expires in March, and all 27 EU countries ratified their infrastructure fund, which is a 750 billion euro fund. So while growth stays low and while inflation stays low in Europe, there's a lot of support, fiscal and monetary support, and we remain overweight to the European area. And certainly it's looking cheap compared to the US, and there's a lot of support coming through from their government. And over to our favorite Chinese president. This was President Xi talking at the recent founding centenary of the ruling Communist Party. And here he was actually talking about foreign forces and saying that they will get their heads bashed in. Ironically, over the month of July, Xi managed to, through his newly upgraded cyberspace administration of China, managed to bash in his own Chinese stock market through some tightened regulations. So it was a very, very tough month for Chinese shares. 12 trillion rand is being destroyed on the Chinese tech index alone from its February peak through a variety of new regulations and concerns about further regulations. So the chart on the right here shows that the NASDAQ Golden Dragon, which is basically Chinese tech shares, and the other line is the US NASDAQ, so US tech shares, and the massive outperformance that the US has had compared to China, with the Chinese Golden Dragon index down 48% from its peak in February. and possibly more today. There was some concerns that China is going to focus now on the gaming sector, which I think is unlikely. They did look at the gaming sector in 2018, and Naspers did fall at that time and recovered. In fact, it's tripled since that concern. And I think we're probably going to see a recovery like that going forward. That a lot of anxiety is priced into the market, and in general, the regulations are good for the long term, good for consumers and good for long-term growth. So what happened? Well, basically the Cyberspace Administration of China, like the CAC or possibly the CAC, has extended its oversight to include overseas IPOs. And this is all about Beijing trying to control their data. As I said before, data is now seen as national security. Everyone's worried about their data, making sure no one else has access to their data. But removing Chinese companies from the US listings is not a concern. Many of them have already got listings on the Hong Kong exchange, and we'll probably see them migrate to Hong Kong over the next year, and that is fine. Index producers, fund managers, everyone's set up to trade Hong Kong. It's just a matter of accessing those shares in a different region. And yes, while there might be some short-term price pressures, those are merely flow driven, and those companies should recover. The educational sector did have some sharp regulations come through in July. And yes, part of that is concerning. The fact that those companies, education firms, have been banned from making profits, effectively nationalized. That is a concern. But it's very much focused on that sector. And it's very much focused on protecting consumers. And the associated regulations are good. They want to promote education within their economy, and education was being abused. So they want online teachers to be licensed. That makes sense. They want to limit the fees. They want to fine false advertising. They want to limit the number of hours that people can learn, and the ages. I mean, below 6 to do online courses is being prohibited. So a number of things to basically mirror what's happening in the rest of the world. So China is trying to improve its regulations, is trying to improve its standards. Yes, they are essentially controlled economy. So when it comes to making changes, they are swift and often draconian. And certainly this on the educational sector was definitely draconian. But it is moving in line with what's happening in the rest of the world in terms of focusing on its data, protecting its data, protecting the consumer, looking at antitrust issues. But there was also some positive news. We saw that China's antitrust regulator gave approval for Tencent, which Naspers is a shareholder in, to take search engine Sogu Inc. private. So certainly business as usual, and the regulator allowing Tencent to take that business private. And similarly, the Chinese authorities convened their banks, not only the Chinese banks, but some global banks as well, in the wake of the collapse of Chinese stocks, to understand what was happening and why there was such an overreaction and what they could do to prevent that. So China is taking this seriously. They're not going to be too draconian about what is happening going forward. They have said that the regulations are very much focused on the education sector. They have said that they're not going to focus on gaming or healthcare or property sectors anytime soon. So I think that the markets, particularly looking at the impact that Tencent has had, or Naspers has had, the market's looking very much oversold. Yes, there are some secondary impacts, particularly for Tencent and Naspers with lower advertising revenues, but I think it shouldn't impact their long-term growth. So we remain overweight emerging markets. And we use this as a buying opportunity. We topped up our emerging market exposure. We did a switch out of our global property ETF into our emerging market ETF. I'll talk more about that later. But we certainly use this opportunity to top up our exposure. And we just generally think that emerging markets have some tailwinds going forward. Yes, it could take a while for the Chinese regulations for that volatility to feed through. So there's no rush to get in. But generally, the dollar is going to stay weak, which is good for emerging markets. Chinese growth is recovering, and there has been some reserve rate requirement cuts in terms of supporting the economy. Increased vaccine supplies in emerging markets as a whole are going to see convergence of vaccination rates, which is good for emerging markets. And now, certainly more than ever, valuations are looking favorable, especially compared to the US. So we do think that this is a good entry point for China and emerging markets. Moving on to South Africa. And unfortunately, I always have to sigh before I start on our own country. What happened this month, the looting and the violence was unprecedented, was horrific. The impact on the economy, on people's just confidence in South Africa has been dramatic. And President Ramaphosa said the actions were intended to cripple the economy, cause social instability, and severely weaken or even dislodge the democratic state. I mean, quite an amazing statement. Terrible events. But certainly when we look at the reaction and the speed of the reaction when it came to South African police and South African military, we could have done more sooner. And here we have Cyril admitting that. He said, we could have done better. And I truly hope that is not something that gets written onto South Africa's tombstone in the future. We could have done better. We know exactly what needs to happen. Execution remains the major draw card, and we do remain underweight South Africa until we see some strength or evidence of that execution. So looking at the month of July, the civil unrest is expected to cost 50 billion rand, reducing 0.5%. So while the emotional impact and the loss of life was tragic, it is tragic, the impact is actually phenomenally large at 50 billion rand, 0.5% of GDP. It's quite small compared to the impact of Eskom, and that remains the major headwind to South African growth. And PwC estimates that load shedding will reduce real GDP by 2.3% in 2021, 5 times the impact of the looting and rioting. So despite the loss of life, when you boil down to the economic impact, Eskom's load shedding is going to be 5 times more impactful to the economy and to jobs than the looting and violence. And it's estimated that load shedding is going to cost 275,000 jobs in 2021. And jobs is certainly something that we desperately need. The chart on the right shows the number of social grants. Now, the gray bars are actual, and the green bars are forecast. This is from BNP Paribas, and the red line is the number of employed. So you can see there, as a result of COVID, the drop in number of employed in South Africa relative to the continued increase in social grants. So the good news was that South Africa did transition back to an adjusted level 3 in July, and Cyril Ramaphosa extended the social relief of distress grant until March 2022 at a cost of 27 billion rand. So this unfortunately wasn't budgeted for. It looks like there are sufficient overruns from the great resource pricing that we have, that we could pay for that from the additional revenue from resources. But looking at the number of employed people versus the number of social grants in this chart on the right, it's definitely not sustainable. We need reforms and we need job growth, and to make sure that we can afford the social grants that are being planned. We also had some other negative news in July for South Africa. Transnet declared force majeure at its port terminals after cyber attack. Talk about kicking you when you're down. It's the last thing we needed. Moody's downgraded 6 of our municipalities for revenue shortfalls that are expected to be ongoing due to weak South African growth. So generally, we desperately need these structural reforms. I mean, on the good side, yes, Zuma is still in jail. Yes, there are plans for the 100 megawatt self-generation to be approved. There are plans for the spectrum to be rolled out. There are plans for infrastructure drive. But again, these all remain plans, and nothing has been seen. There are rumors that Cyril is going to clean house and reshuffle his cabinet. And we can only hope and pray that he does use this tragedy as a force to clean house and to reshuffle the cabinet. But we'll wait and see. And until that, we remain underweight the rand, or remain underweight South Africa. We are hopeful, very hopeful, but hope is not a great investment strategy. So we remain underweight. But that said, although we remain underweight the rand and underweight South African equities, we remain overweight South African bonds. South African bonds continue to offer incredibly great value. We've got the medium-term budget, which has been postponed till November, but it is likely that we are going to see a good debt to GDP number come out of that, not because of any great levels of expense curtailment, but because of revenue overruns due to fantastic commodity prices. And so we think that despite the expense overruns, that there'll be more revenue overruns. And in fact, our debt to GDP numbers will either be on target or slightly better than target, which means lower bond supply, which is good for bonds. So when you compare this to European bonds at 0% yield, and Japanese bonds at 0% yield, or US bonds at 1% yield, to get close to 10% for South African investors is just absolutely fantastic. So we remain very overweight South African bonds. Within our balanced portfolios, we overweight South African bonds in our income maximizer, and we underweight cash and underweight credit as a result. So looking at positioning, so we did two changes or two switches to our global portfolio in the month of July. The first I've mentioned already, we halved our position in our global property portfolio, the Sygnia global property ETF. It's been a phenomenal performer, best performing ETF year to date. So we're very happy to bank some of those gains and rotate that into emerging markets, which, as I've mentioned, we think remain a good place to be, good valuations, converging vaccine rollout, great entry point from a valuation perspective with the Chinese regulatory concerns, and strong economic growth coming through, as well as weak USD supporting rest of the world growth. But the other change we did was we sold out of our FANG portfolio and bought Fourth Industrial Revolution. This is the first time we bought Fourth IR in over 18 months. So it was quite exciting to get back into our Fourth Industrial Revolution portfolio. So this was driven partly by price moves. FANG has had a really good, the FANG stocks have had a really good run, thanks to some very good results. But Amazon's results came out a few days ago, and they look like they're going to weigh on the sector going forward. And maybe there was always the very sort of rough rule of thumb that when a company built brand new head office, it was a good time to sell them, and maybe the same applies to when a company's CEO or ex-CEO goes into space. It's a good time to sell. So we have rotated out of FANG. Fourth Industrial Revolution has underperformed year to date. It's underperformed FANG stocks. It's underperformed S&P. It's underperformed value. It's generally, well, it's positive. It's had a good return. It has lagged, and so we thought it was a good time to from a pricing perspective to get involved. But also there are a number of other reasons why we think it's a good place to be. We've been looking for a good way to get exposure to the US domestic infrastructure program. As I mentioned, it's now a $1 trillion program that's been approved. Yes, it's over the next 5 years, but there will be a strong focus on making America great again, a lot of relocating manufacturing to the US, creating jobs in the US, and strong industrial production within the US. Now, the US has two headwinds. One, they are actually quite close to full production on a number of their economies, and there is some labor shortages at the lower end of the economy. So while that it provides headwinds, the chart on the right here shows robot density in manufacturing for the US, which you can see here is in the middle. Singapore and Korea on the left-hand side at nearly triple what the US is at. Then Japan, then Germany, Sweden, Denmark. So the US has got a long way to go. So one of the good ways to play the US domestic infrastructure plan is actually not through commodities, because commodity prices have run very hard, but is to get exposure to robotic producers, which you can do through the Fourth Industrial Revolution Fund. So we are quite excited about that. The other way to get exposure to it is, the other thing we'd like to get exposure to is decarbonization. So yes, ESG has become a big focus, and decarbonization of the global economies is something that is very important, and a lot of people have forecast the impact on various commodities. So the first one is copper. That is certainly going to have the biggest impact. Copper is the biggest beneficiary from decarbonization. Electric vehicles, for example, use a lot more copper than petrol vehicles. However, China uses 8.5 times more copper than the US. So in the short term, when China is slowing down and they're moving away from property production, and they're moving away from infrastructure and material production, the slowdown of China is going to far outweigh the copper usage from decarbonization. That's a very long-term, 20-year process. So although it will add to demand over 20 years, in the short term, it's going to have almost zero impact. In the short term, China uses 8.5 times more copper than the US, and copper prices are at decade highs. So we certainly think that the euphoric copper prices on the back of decarbonization is probably a little bit overdone. If you want to play decarbonization, a better way to do it is through hydrogen fuel cells. And the Fourth Industrial Revolution Fund has some great exposure to some hydrogen companies. And certainly when it comes to ESG, I think this is going to be a big winner. It is certainly much cleaner than electric vehicles. I've spoken about batteries in the past. According to Util Analytics, lithium-ion batteries, lithium mining performs devastatingly badly on a number of sustainable development goals. It has a detrimental impact on water quality, ecosystems, pollution, desertification, and deforestation. So while a number of mining companies are trying to expand their lithium mines, there's a lot of protest and potentially regulations going to prevent them from doing that. On the other hand, hydrogen is a beautifully clean fuel source, and more importantly, it does better in heavy vehicle propulsion. So if you think of public transport, what you want to do is reduce the overall world's energy intensity, and the best way to do that is to move to public transport, and certainly hydrogen fuel cells would be a big beneficiary of that. While the focus has been very much on electric vehicles, and they have been the darling of ESG stocks, I remain concerned that there is going to be some headwinds from the battery side of electric vehicles, and that certainly hydrogen fuel cells will make their place. Yes, if you look at the chart at the bottom right, it's still very expensive, hydrogen versus coal, but that price is coming down rapidly and is expected to match coal within the next 30 years. So that's something that is great to have exposure to, and as I said, the Fourth Industrial Revolution Fund does have some exciting exposure to that sector. So we're excited to be back into the fourth IRR fund in our balanced portfolios. Still a relatively small position compared to some of our other overweights, but we are back in. So looking at our overall positioning, I have changed this slide slightly for those of you who know it well. The gray dot, so this is basically our global equity, global listed equity positions in the satellites. The gray circle is our value position. We remain overweight value. We think with US bond yields going to rise over the next 6 to 12 months, that we are very comfortable continuing to have that value position. The plus numbers are referred to the size of overweight, so we've got a plus for overweight for value. We are looking to actually increase that position because bond yields have fallen so dramatically, but at the moment we keep that the same as last month, +4. The reason it's in gray is that we don't think it's something you want to own for the long term. So long term, we remain convinced that we're in a low growth, high volatile environment, and as a result, you want to have exposure to sectors that have their own endemic growth. So either creating their own markets, which steal market share from other companies, or growing population segments, or growing demand sectors. So the other satellites are thematic investments we think that you should have for the long-term value, something we believe you should have for the short term. That's why we don't have an ETF in that space ourselves. We do get exposure through iShares, and we think that that's a short-term exposure as bond yields rise and as growth recovers. The bond alternatives, because we don't have any double bonds, we have our Sygnia Global Property ETF. So I mentioned we've halved that exposure from a +4 to a +2, and used that to increase our emerging market exposure. So our emerging Asia, that has gone from +6 to +8. So that's currently our biggest overweight. Disruptive technologies, that focuses on the FANG portfolio and the fourth industrial revolution. That remains the same size at a +2. We've just rotated out of FANG and into fourth industrial revolution, we may look to increase that as bond yields rise and volatility gives us some good entry points, but we think that'll only be over the next 6 to 12 months, so not rushing into that anytime soon. Health innovations remains a +4, some very, very good price action over July, like we had in June, and some very good results coming out of a number of healthcare stocks. And we're very excited to announce the healthcare launch, our ETF, the 6th of July. We'll be launching our own ETF, so we think it's a great entry point. There's still a lot of runway left for these stocks. Great structural background. You've got, in the short term, you've got very strong profits. In the medium term, you've got R&D, massive amounts of R&D, which will lead to new solutions, new vaccines, new healthcare remedies for a number of diseases. And long term, you've got aging demographics and aging populations with rising incomes, all of which means they'll be spending more on the sector. So Eva will be doing an ETF on the launch date. So please tune in for her ETF. She'll tell you a lot more about. Sorry, please tune in for her webinar. She'll tell you a lot more about the ETF and why it is such an exciting place to be. We certainly are, as you can see, +4. It is our second biggest overweight, and we remain overweight our healthcare in general, with our OSI allocation as well, which is also very much focused on the healthcare sector. Looking at the center of this position, on the core side, which is exposed to passive and market cap weighted strategies. Within South Africa, we remain underweight SA equities, a small underweight because there is a lot of value, but there's the value's there for a reason, and because of the uncertainty. Remaining overweight South African bonds because of the great yields. Overweight global equities because we think the rand, although sitting right now at 14.5 is pretty fair, we think long term the rand will continue to weaken. And underweight global bonds because of the distortions from quantitative easing, and at the same point we also don't have any gold. Yes, the US real yields are looking really low, and yes, there's some short-term inflation, transitory inflation that's going to come through, but we'd much rather have exposure to emerging markets, which have a solid earnings underpin, than to global bonds, which are distorted by QE, and gold, which is distorted by QE. So that is our positioning. Let me move on to questions. Okay, this is a little bit odd because I can't see any questions. There we go. Okay, another great question from John. Unfortunately, we have to say this every month. When will the Sygnia living annuities allow more than 30% offshore exposure? So unfortunately, we only get the numbers for the end of June, 6 weeks after the cutoff. So mid-August, we should have those numbers, at which point, if they are below 40, and we are very optimistic they'll be below our limit, we will apply to SARB, and hopefully this time next month, I will tell you that we have or are able to raise that limit from 30% to a higher number. Alfonso, question on our future ETFs. Yes, we're very excited about the healthcare ETF, which has been launched on the 6th of August, but we do have plans. We have applied for a China ETF, and we've also busy designing an autonomous tech ETF, which has got a climate change overlay. Both those are very exciting, but those will be towards the end of the year or only early next year, depending on the time frame. As I mentioned before, ETFs take quite a while to get approved, and particularly when you're focusing on China, opening up accounts in China takes a little bit longer than the developed market. Okay, so a question from Yaku about why the JSE has performed steadily despite so much negative news. And that's been primarily resources. So the resources are very much dependent on, or resource shares are very much dependent on commodity prices, and less so on South Africa specific news, unless the SA news impacts our ability to mine, like load shedding. But all the negative news that came through the month of July was either focused on Naspers through Chinese tech, or was focused on South African industrials and financials, or SA Inc. stocks through the civil unrest. The mines weren't as impacted. And so resource prices did very well. I think the resource sector was up 14% in July, whereas financials and industrials were flat to negative. So yes, the negative news did feed through to South Africa. It just, as a whole, because of resource prices, didn't come through to the overall indices. He also asked why we should have exposure to fourth industrial revolution if you're worried about US stocks being overvalued. So the S&P 500 is looking overvalued, but it's very much dominated by the large cap shares. The fourth industrial revolution, where we've moved our exposure to, has got exposure to small caps. There's 400 shares, all quite new, or newly listed, generally small companies, and they haven't seen the same massive beneficiaries from just strong flows into the broad indices in the US. And so there is more value sitting there than there is in the large cap US. Another way to play this is to look at US small caps, like a Russell 3000 index. We don't have a Russell 3000 ETF, but that is another way to play it. Another way to get exposure to the US is to look at US value stocks. Those certainly aren't looking as overvalued. So we are looking at finding other ways of getting exposure to the US. Fourth industrial revolution is one we like. We might look at US small caps. We might also look at US value stocks for our balanced portfolios. Okay, very good question from Errol. Errol says he's 100% invested in the Sygnia All Bond Unit Trust, and the yields are very good, and he's very happy. But what are the risks? So that's a fantastic question, Errol. And it's very important that people are aware of the risks. So yes, you get more than double the yield from the Sygnia All Bond Unit Trust. You're getting close to 10% compared to the money markets unit trust. You're getting 4%, and banks are getting 3%. But bonds do have volatility. So if you don't need access to the capital, if you're just living off the yield, then you're fine. So if you put in 100 Rand and you want spending the 10 Rand that you're getting in the yield every month, it's better than putting in the bank where you're only getting 3 Rand 3 Rand every year. But if you need to spend that money within the next 3 months, your capital is at risk. If the Rand were to weaken suddenly because of a risk-off event, or if global bond yields happen to rally because growth is a lot stronger than expected, both of those will push our bond yields up. When our bond yields go up, our prices go down. So we definitely think that the bond, you should own, if you need the money within a year or two, maybe you only put 25% in bonds. And only if you've got a long-term time horizon, like 5 years, and you're not worried about your capital, then you can afford to get those higher yields. But certainly, if you need the money within 3 months, your capital is at risk by putting in bond funds, and it should be you should rather have your money in the money market fund. What I failed to mention, and I apologize, the zero fee campaign for our Sygnia All Bond Unit Trust and the Sygnia Money Market Unit Trust have been extended. So you pay 0 fees for a money market unit trust and 0 fees for the bond unit trust. And the impact has been amazing. Our our money market unit trust is now the #1 performing money market unit trust. Just because you take off, I mean, obviously we don't want to take it all away from the portfolio managed. We do manage that portfolio very prudently and very well. But when you take away all your costs, and because money market funds are generally quite closely situated to each other, or we suddenly jump to #1. So if you're looking for somewhere to put money where your capital there's no capital volatility, the money market unit trust, 4.2% yield, no fees, and that's until the end of 2022. So no fees for the next 18 months, really, if you buy by the end of the year. So it's been extended until the end of this year. So please take advantage of that. If you can afford the volatility, go invest in the Sygnia All Bond Fund. You're getting 9.3% yields, no fees. And if you need capital protection, the Sygnia Money Market Unit Trust, where you're getting 4.2% yield at the moment. Christopher has a concern about China. He says that their demographics are poor, and he's spot on. So the first country in the world that was plagued by aging demographics was Japan. That was nearly 2 decades ago. Europe hit the same headwinds about 10 years ago, where the increase in number of people working started to decrease. The US is still about 5 years away, and China has just reached that point where you're seeing a slowdown and no further gains to GDP growth from population growth. They have increased the number of children you can have from 1 to 2 and now 3. And that's one of the reasons why they've changed the education regulations. Is they're very focused on protecting that new demographics that comes through. However, when we're looking at investing in China, it's not so much about the low birth rate. It's about the emerging middle class that we're seeing there. And there's a very, very strong emerging middle class as people move from the rural areas into the cities, as their living standards increase, as their incomes increase, and as their spending power increases. And it's not just China, but it's the emerging Asia, and that's where we're seeing the strongest rise in living standards and the largest increase in number of people in the middle class sector. And that is your biggest spending demographic. And that is one of the reasons why we think that there's strong tailwinds to investing in Asia and China in the long term. Amazon, we are neutral on Amazon in our FANG fund. We're sitting at a benchmark weight. Sorry, we were neutral on Amazon, setting a benchmark. We actually used the negative outlook that they gave recently a few days ago to take that to a small overweight. So we've taken a small overweight in Amazon. We do think that it is expensive. I mean, it is sitting at a massive PE. It's never been a problem before for Amazon performance, and the new CEO is unproven. But it has got a fantastic moat and fantastic businesses, and barring any major antitrust issues, it's a solid business. So within the FANG fund, we have taken that to a small overweight. Of course, we have also now taken FANG to underweight. So net, probably got a negative view, or slight underweight in our balanced funds. There's a question from Andrew Stein. Andrew, thank you for your question on the rising petrol price within South Africa and its impact on inflation and consumer spending in South Africa and the oil outlook. So oil is something I haven't touched on, and it has been quite interesting that there has been such a strong resurgence in the oil price despite the lack of demand. It's still, we're nowhere near the demand usage that we had pre-COVID, and we certainly are in the new normal when it comes to a lot less travel than we had in the past. And it's looking like a good decent chunk of that new normal will stay. We don't know if there's going to be a fourth wave, probably will. Yes, there's vaccine rollout, but it seems that people have learned to accept, or at least embrace, some of the benefits that lower mobility has and that COVID has brought. And one of those is the great technology benefits, using Zoom, traveling less, virtual reality. It's certainly something that has become more an accepted way of life, and one of the reasons why we think that oil demand is not going to recover to the heydays that it did have. At the same time, more of a longer term structural headwind, is moving away from oil in terms of propulsion for vehicles, towards battery power in cars, and hydrogen power in trucks and larger vehicles. And that certainly will impact the longer term demand for oil, but that's not a short term story. So the reason why the price has actually recovered is that the supply is still constrained. So OPEC is trying its best, or OPEC Plus is trying its best to ensure that supply remains curbed, so that there's some sort of balance, supply-demand balance and equilibrium that keeps the oil price relatively elevated. And we have seen oil sitting in the mid-70s, which has along with a slightly weaker rand, impacted South Africa. I don't think oil is going to go much higher than it has. OPEC is already struggling to get all its members to agree on the cuts. Everyone wants to take advantage of the higher prices, and there's already increased supply. So I think that oil prices will have some volatility, or probably come a little bit lower as OPEC struggles to agree on further supply agreements. That said, there's limited impact on South African inflation. Strong rand has certainly helped dent any imported price inflation within South Africa. Of course, there are other causes of inflation within South Africa. I mean, we have supply bottlenecks like the rest of the world that are COVID related, that will lead to short-term inflation spikes. And the big question is, when will the SARB increase rates? I don't think the SARB is going to increase rates this year, although if inflation is roughly on target at 4.5%. Next year, inflation is expected to be 4.6%. This year inflation is expected to average 4.6%. Next year, inflation is expected to average 4.3%. So certainly, inflation expectations are fine; they're in line, and they will not lead to any major increases from the SARB. And while we have such uncertainty with the looting and violence, and while there's uncertainty with regard to COVID, I think the SARB is going to be very reluctant to hike too quickly. And I think that inflation is going to stay relatively muted within South Africa, and barring inflation that we will see in bottleneck areas is not going to come through too strong. Unfortunately, petrol price will go up because of additional taxes, just like the sin stocks sin consumption, alcohol and cigarettes will go up along with higher taxes. So we will see higher taxes feed through, and that will not only impact inflation slightly, but also consumer spending. So consumer spending, I think, is also struggling because of lockdowns. It's struggling because of job losses, and that's one of the reasons why inflation expectations aren't growing too quickly. The economy is just too fragile right now. There's too much else that is impacting consumer confidence and this consumer's ability to spend, to push prices aggressively higher. So I think that I don't think there's going to be too much concern on. I'm not too concerned about inflation within South Africa. I'm not too concerned about a large number of rate hikes coming through. The FRA market was pricing in up to 1.5% price hikes over the next 12 months. That's since come down to 1% hikes. I still think that's over optimistic. I think we might see somewhere around a 0.5% increase come through probably early next year. And that is that. Let's see if there are any more questions. Sorry, a few more questions that have come through while I've been talking. Vili has a tough question that we get this all quite frequently. With a long-term view, would you discourage entry into FANG right now? So no, I wouldn't. I think that if you have a long-term view, that FANG, all our growth thematic satellites are a good place to invest for the long term. Right now, it's not a great entry point, and that's why we're switching to 4th IR, but that's on a short-term view. So that's very much a short-term view. You know, we could find ourselves rotating back into FANG within 6 months. But certainly on a long-term view, it's very difficult to time markets. We do it very carefully with very small tranches, very low cost. So our long-term view, we remain very bullish on all our thematic thematic satellites. The only one we don't have a long-term bullish view on is value, and that's why we don't have our own satellite, because value is something that only works well in a roaring economy with roaring growth, and we just have too many headwinds to get back to that environment. Tencent, we're not too concerned. Karusha, good question on Tencent. We're not too concerned about Tencent. They've got almost zero exposure to the education sector. Yes, there'll be some short-term headwinds from advertising, but I don't think, I'm not concerned about the Chinese crackdown. There were some media reports out today, which is why Tencent was down 6% today about focusing on gaming. But the Chinese regulator came out a few days ago after they met with the banks to say that gaming is not something they're going to be focusing on. And they did focus on gaming in 2018. So I think that generally the investment case of Tencent remains, and we remain comfortable with our Swix benchmark, which has a higher weighting to Tencent than the cap Swix. Mike Adams, yes, it's the rationale for bonds, the 5 years. It does apply to income maximizer. If you read the fact sheet for income maximizer, it says that the time horizon is 5 years. And that, you know, it all depends on your entry point. If bond yields do sell off, you can probably have a shorter time horizon. But right now, you know, bond yields are sitting around 9.5%. They have been as high as 14%, you know, when we had Nenegate. So, you know, that you can, I'm not predicting any wobbles, and I'm not predicting anything, but, you know, black swans do happen. And so, you know, income maximizer has, it's not as aggressive because it only has 70%, 70 in bonds, not 100%, but it certainly does have more capital volatility. And that's why it was designed for living annuities, people who are living off their income and not off their capital. Unfortunately, OSI is limited due to our cap on the 30% global cap on our living annuities, and OSI is currently closed. But we actually are looking at reopening that, possibly if we get, we might have some more capacity, and certainly if we get a SARB approval to open up above 30%, that will be reopened. So we're looking at it, and we hopefully can, we are trying to get some more capacity, and hopefully we can open OSI up soon. Yeah, 1 to 3 year view on the ZAR is, so it has to be weaker. You know, over the next 6 months, it could strengthen because of commodity prices, and some the weak dollar. The dollar real yields in the US are the weakest they've been in history, which has to lead to a weaker dollar, which leads to a stronger rand. So short term, the rand could get a bit stronger, but longer term, over a 1 to 3 year, 5 year view, I think the rand is going to weaken. Lorraine, if a youngster wants to invest 500 rand per month, which funds would you recommend? So assuming by youngster you mean someone who has not, who has a long-term time horizon, we've got a very exciting product coming soon called the Stargazer portfolio. But until that is launched, I think my favorite fund is the Skeleton Balance 70. I think that is just the most fantastic fund you can get. It's 35 basis points. It gives you exposure to all our thematic satellites. It's balanced, so it's got a risk-adjusted return, and it's just phenomenal. If you want a little bit more risk, and then you can invest directly into one of our ETFs, either if you like the SRI angle, you can invest in our S&P 1200 Global ESG Fund. If you like the tech angle, the Fourth Industrial Revolution Fund, and if you like the healthcare angle, well, please join the health ETF, or there's the Health Innovation Unit Trust. But those are 100% global equities, so they're a little bit more higher risk. But you know, my favorite fund is Skeleton Balance 70. I just don't think there's a better fund in the market. There's a question on India. We've looked at India as a theme. India does fit within our emerging markets 50 ETF. There is an exposure to India there. So we'd rather play India through that theme, through the emerging Asia theme. To have a dedicated India ETF right now, I think is too soon. Costs are very high, liquidity is very low, and it's a very narrow market. It's not a great market to invest in on its own. So we're avoiding having a dedicated India ETF for now. Sorry for any confusion. The FANG fund is still there. The FANG fund is, we run the FANG fund. The FANG fund is awesome for long-term investors. We just did a short-term switch for our balanced funds out of FANG to Fourth Industrial Revolution. Didn't have a big impact on the fund. Fund is still close to R1 billion. It's still looking strong. Performance is still great, and it's there for long-term investors. And that fund's not going anywhere. It was a short-term view that we had. John asks about a pan-European ETF. Yes, we have our Euro Stocks 50 ETF, which doesn't have allocation to Switzerland, unfortunately. Again, we've looked at Switzerland as a standalone, and we've also looked at Australia and Canada as standalone ETFs. There has been some interest, and it's certainly something we are considering, to add Switzerland, Australia, and Canada. And that may happen, but we don't have any plans at the moment. That's just something that we're looking at. A good question from Thomas: the difference between the healthcare ETF and the Health Innovation Fund. So the healthcare ETF tracks the sole active global 150 healthcare index, whereas the Health Innovation Fund is an active fund, and it has exposure to OSI, it has exposure to genomics, it has an overweight in biotech. So they are similar-ish in that they both have healthcare exposure, but the Health Innovation Fund has some tweaks in it to some overweights to some of the sectors that we really like. So the ETF is market cap weighted, whereas the unit trust has overweights to some of the themes or the sectors like biotech, healthcare that we like. We're thinking about adding in a cannabis overweight to that unit trust as well. So the health unit trust is active, whereas the healthcare ETF is passive. Hugh has a great question on the FANG holding. Yes, okay, so the switch that we've done out of Fourth Industrial Revolution, FANG into 4th hour, is a short-term switch based on capitalizing short-term volatility. For our balanced funds, we do our best to harness volatility to improve performance, but on a long-term view, we remain holders of FANG. And if you have a long-term view, if you don't need your cash within the next 6 months, I'm not recommending that you switch out of FANG. If you need your cash within 6 months, you probably shouldn't be in FANG anyway. So you're only in FANG because you've got a 5-year time horizon. If you've got a 5-year time horizon, then that's great. What I am saying is, if you have new money, and if you want to top up one of our satellites, right now I'd be topping up 4th hour. 2 months ago, I'd be topping up FANG. So what I'm trying to just assist with is, if you do have new money and you are topping up your investments each month, then right now is a good time to top up Fourth Industrial Revolution. Right now is a good time to top up emerging markets, as opposed to topping up global property or FANG. So rather direct new cash flows than actually an outright sell. What is your opinion on investing in the MSCI USA Index ETF? We have 2 ETFs that focus on the US. The US is a phenomenal region. It makes up 67% of the MSCI world. So when we are underweight, we still have about a 55 or 57% exposure. We still got more than half of our funds exposed to the US. So we are underweight because of valuation and for a number of reasons, but the bulk of our assets and the bulk of our global money still sits within the US. So if you had to pick one region I would pick the US because it has the most market-friendly economy and the most creativity and the most interesting companies with moats. So in a balanced fund, we think 67% is too much, and so we're happy to underweight slightly, so 57. But and if you had to pick one global ETF, well, the best is to pick the S&P 1200 ESG, which is diversified across the world. But if your biggest exposure is the US, so if you had to pick one region for the long term, I'd still pick the US. We just happen to be underweight at the moment. So the question from about the commodity boom: will the commodity boom tax benefit not be offset by consumer inflation, reducing expenditure and lower tax revenue? That is definitely true. We are seeing some inflation coming through as a result of higher commodity prices. But as I said before, it applies in the US. I think that this is, so first of all, a lot of the commodity prices are already rolling over, and those that haven't are likely to. So the impact on inflation from high commodity prices is likely to be transitory. It's not likely to be sticky. It's in the base. Unless commodity prices double from here, which is definitely not my base outlook, we think that they're going to come off, not double. Inflation will actually come down as a result of commodity prices over the next 12 months. There is some semiconductor exposure within the Fourth Industrial Revolution Fund, as well as the emerging market ETF. So both of those have exposure to semiconductors. And that seems to be the last of the questions. So thank you, everybody, for joining. I hope that you have a good August. I hope that it treats you well. For those who have been vaccinated, that is great news. For those who are waiting to be vaccinated in August, I hope that goes well and that everybody is safe and has a healthy August. And I will see you next month. Cheers.